let's say a company wants to build a new factory. Should it sell a piece of itself by issuing stock, or should it just borrow the money? That right there is the core question of capital structure. And, for decades, the most surprising answer from some of the smartest economists was it doesn't matter at all. Today, we're going to dig into why they thought that, and more importantly, why the real world tells a completely different story.
Okay, so here's our game plan. First, we're going to start in this perfect theoretical world of finance to get our heads around a really shocking idea called the irrelevance proposition. Then we'll come crashing back to reality and see how real-world stuff like taxes and bankruptcy changes absolutely everything. After that, we'll see how these financing choices actually become powerful tools for control. And finally, we'll zoom all the way out to see how one company's debt can send ripples through the entire economy.
All right, let's dive in. We're starting with a foundational theory that, I gotta tell ya, sounds completely wrong at first, but it is the bedrock for everything else we're gonna talk about.
So here's the puzzle. If you, as an investor, can create pretty much any risk and return profile you want by buying a mix of stocks and bonds, why should you care how the company itself mixes those ingredients, right? Shouldn't the company's total value just stay the same no matter what? You see, the brilliant insight here is that investors can just undo whatever the company does. Let's say a company you like takes on a ton of debt, but you're a bit more conservative. No problem. You can just buy both their stock and their debt. In your own portfolio, you've basically created a leveraged down version of the company, which is why their choice becomes, well, irrelevant to you.
Think of a company's total value as a pizza. This theory says that taking on debt using leverage doesn't make the pizza any bigger or smaller. It just changes how we slice it up. The debt holders get a safer, more guaranteed slice, and the equity holders, well, their slice is smaller, but it has more potential upside. The risk is just moved around the plate.
So the bottom line of this whole idea is simple. In a perfect world, a company's value comes from what it actually does. Its factories, its patents, its people, not from some clever financial engineering. But as we all know, we don't live in a perfect world. So now let's start chipping away at that perfect world idea. Because the moment we introduce just a few real-world imperfections, this whole theoretical model just kind of explodes into something with very, very real consequences. Yeah, these real-world imperfections are what economists call frictions. You can just think of them as sand in the gears of that perfect financial machine we were just talking about. And it's these frictions that make the choice between debt and equity so incredibly important. We're going to focus on 4 of the biggest frictions out there. First, taxes. Second, the very real and painful costs of going bankrupt. Third, what are called agency costs. That's the conflicts of interest inside a firm. And fourth, the simple fact that managers almost always know more about the company than outside investors do. And the first and honestly most powerful friction is the tax code itself. In most countries, when a company pays interest on its debt, it gets to write that off its taxes. But payments to shareholders, like dividends, nope, no deduction. This tax shield is a huge, direct cash benefit. It's basically a government subsidy for using debt. Okay, so that leads to a really obvious question, right? If debt gets you this great tax break, why don't companies just load up on it? Why not finance themselves with 99% debt? Well, the answer brings us straight to the terrifying dark side of leverage. Because with all that debt comes a massive risk: bankruptcy. And let me tell you, bankruptcy isn't some neat, clean process. It's a value-shredding machine. Your best employees start polishing their resumes. Your customers get nervous and flee. And suddenly your suppliers want cash up front. The business itself just starts to crumble. So firms are constantly walking this tightrope, trying to balance that nice tax shield from debt against the awful cost of falling off. So we can see it's not just a simple trade-off between taxes and bankruptcy. The choice between debt and equity is actually way more strategic. It's a powerful tool for shaping how a company is run and what it signals to the entire world. And this right here is a huge shift in how we think about this. Capital structure isn't just about getting cash in the door anymore. It's a governance tool. It's a way to influence the behavior of the people actually running the show. This is where things get really strategic. See, debt isn't just a loan, it's a leash. That mandatory interest payment you have to make every single quarter, it forces managers to stay focused, to be disciplined. There's no room for wasteful vanity projects when you have a banker breathing down your neck. It's an incredibly powerful way to enforce discipline. Which brings us to another one of those key frictions, asymmetric information. Look, managers know way more about a firm's real prospects than any of us on the outside, so their financing choice sends a powerful signal. If a company suddenly decides to issue a bunch of new stock, investors might think, maybe management thinks the stock is overpriced right now. But taking on debt, that can signal real confidence. It's like management is saying, we are so sure we can make these payments, we're willing to bet the company on it.
Okay, so far we've pretty much been looking at this from the perspective of a single firm. But what happens when thousands of firms all start making similar choices at the same time? Let's zoom out and see how these small individual decisions can add up to create huge system-wide fragility.
This is really where we connect the dots between one company's balance sheet and the health of the entire economy. You see, one firm taking on debt to be more efficient, that's just smart business. But when everybody does it at once, it can fundamentally change the risk profile of the whole system.
And here's the dangerous feedback loop of leverage. When times are good and everyone's optimistic, companies borrow more, which fuels even more growth. But then, when an unexpected shock hits, like a recession, that same debt becomes an anchor. Suddenly, everyone needs cash at the exact same time, forcing them to sell assets into a falling market. This just crushes prices and can turn a regular downturn into a full-blown financial crisis.
And that really is the ultimate takeaway here. These choices made in a single boardroom, driven by things like taxes and internal incentives, well, they have ripple effects that contribute to the stability or the fragility of our entire financial system.
And so we are left with this huge unresolved dilemma. We know that debt can be a great tool to make individual companies sharper and more disciplined, but we also know that when everyone uses that tool at the same time, it can create the conditions for an economic collapse. So how do we balance that? How do we get the benefits of discipline without creating massive systemic risk? That's not just a puzzle for CEOs. It's a challenge that affects every single one of us.